Someone to remind me that question? There is a question where we were supposed to solve on current tax. Thank you. Hey, Vera, sidhani kama 2021 kuna current tax. Vera, wewe upodanganya mimi. September 2015. Yeah, it should be that one. This one really. September 2015, question 3B. So which page was that? For the purpose of those people who what were last time, initial part, see. I already got the question, so kindly. All right, so allow me to read the question. Allow me to read the question. It says, Sophistic Limited, newly listed company, has provided the following information with regards to computation of its tax expense for the year ended 31st May 2014. May 2014. So accounting profits, depreciation, donations, amortization of software. Then we have capital allowances, tax expense at 25%, as you can see. The company has not yet determined tax expense for the year ended 31st May 2015. So additional information, accounting profits for the year ended 31st May 2015 was shillings 55,200, while donations amounted to 600,000. An extract of non-current asset movement schedule for the year ended 31st May 2015 was as follows. So we have cost on 1st June 2014 for the plant and software, then additions during the year. We can see there accumulated depreciation, then tax written down value. There was no additions. So tax written down value, fine, no problem. Plant is depreciated at 20% per annum using the straight line method, while wear and tear allowance on plant is provided at 25% on reducing balance basis. Software development commenced in the year ended 31st May 2011 and was completed in the immediate subsequent year. The company capitalized development costs, which amounted to shillings 9 million. Just a minute, yes. Yes. Okay. And amounted to 9 million and amortization commenced on 1st June 2012, using the sum of digits method over the estimated useful life of 5 years. Software development costs are allowed in full for tax purposes in the year in which they are incurred. Donations made by the company were not tax allowable. Corporate tax rates applicable on the company's earnings for the year ended 31st March 2015 is 30%, and the company is expected to continue generating taxable profits in the foreseeable future. Required current tax to be charged in the income statement for the year ended 31st May 2015. So the other two parts, part 2 is deferred tax liability and deferred tax liability account. So I will not go to deferred tax. At this point, I just want us to concentrate on the current. The issue is they are not very keen on examining current tax. So as I said the other day, we are not going to waste much time on current tax. So we'll just calculate the current part of it. Then once done, I will introduce deferred tax. Then maybe tutafanya hizo zingine baadaye. So for now, we are only computing the current tax part of it. So we start. So to calculate, they want us to calculate the current tax for the year 2014. Sorry, 15. And up there, they calculated for us. If you check where the question started, they calculated for us the tax for 2014. So the arrangement which was given up there is the arrangement you're supposed to follow. Because how do you calculate current tax? Current tax, you take the tax rate times the taxable profit. So taxable profit is the accounting profit. You add back the disallowable, then you subtract the allowable expenses. So if you check their schedule for 2014, check up there. For 2014, they just gave us, actually 2014 is to give us the guideline on how to work out 2015. So we are going to follow that guideline which was given, but now we take the figures for 2015. So in fact, let's start immediately. So right there, Sophistic Limited. Sophistic Limited. Current tax. Current tax computation. Current tax computation for the year ended 31st May 2015. So accounting profit for us to understand, allow me to join you fully in the question. What was the accounting profit for 2015, if you can be able to see it? So we are following the schedule for 2014, but we picked the figures for 2015. So how much can you be able to see as the profit, accounting profit for 2015? Just check across and let me see the figure from your side. From your side, Mwende and Vero. So that is, yes, in note 1, the figure is correct. Check note 1. The accounting profit for the year ended 31st May 2015 was 55,200. Correct. We are working in thousands, so 55,200. So I want you to stick to the schedule for 2014, but we now bring figures for 2015. So they added back depreciation. So add depreciation. add depreciation. So depreciation, we are going to add for 2015. 2015, kindly read note number 3. Let's move to note number 3. Plant is depreciated at 20% per annum using the straight line method. Straight line is whereby you depreciate an asset on cost throughout its useful life. So you depreciate on cost. So it means just go and check the cost of the plant, then multiply by 20%. So when you check up there, cost on 1st June 2014 of the plant was 32. So you will take 32 times 20%. Give me the figure. So depreciation is 20% times the cost of the plant. Cost of the plant is 32. So what is 20% of 32? $64, is that? So 6,400. You add back. Depreciation is not allowed for tax purposes. If you allow people to charge depreciation, tax, especially Kenya, you don't allowing means it should be subtracted. When you subtract, you reduce the profit. The lower the profit, the lower the tax. Tukishajua sisi kama kampuni tutaenda kulipa tax mingi. Tuseme tutaenda kulipa tax ya 8 million. Tunanunua tractor. Tunasema sasa kila mtu instead ya kuwapea hiyo 8, wacha tununue tractor ya 8 million. Then tunaweka policy that all our assets are depreciated at 100% in the year of acquisition. While depreciation is a management policy, nobody will question you. So unaweka 100%, so the depreciation comes to 8 million. You reduce the entire profit, zero tax. So that is why taxman cannot allow people to charge depreciation for tax purposes. So when you get depreciation, you add back. Why are we adding? Prior, before PBT, profit, the accounting profit, already on depreciation as an expense. So you add back. You don't allow, you disallow. Donations. So you also add back donations. But if you donate to charitable institutions like children's home, those ones are allowed. But there are some which are not allowed. So like in this case, they were not allowing. For example, if you donate to political party, that one is not allowed for tax purposes. So you add back. So our donation, I saw it in note 1 as well. Donation, I saw it in note 1. It was 600. If you check additional information number 1. So then the one remaining is for disallowable is amortization. So we are remaining with amortization. Correct. So amortization must be on the software. Amortization must be on the software. So let's read note 3. This note 3, no, note 4. Let us read note 4. It says, and I read, software development commenced in the year 2011 and was completed in the immediate subsequent year, that is 2012. The company capitalized development cost. Capitalizing means they recognize it as the cost of the asset. That recognition is what we call capitalization. So the company capitalized the development cost, which amounted to 9, which we can even see up there in schedule upper number 2, upper note 2, we can see software is 9. And amortization commenced on 1st June 2012 using the sum of digits method. Please underline that, sum of digits method over the estimated useful life of 5 years. Okay. Software development costs are allowed. Software development costs are allowed in full for purposes in the year in which they are incurred, no problem. The cost is what's allowed, but amortization is not allowed. So we want amortization. They started amortizing the asset on 1st June 2012 using the sum of digits method. So we are in which year? We are dealing with 2015. So 2012 to 2015 is how many years? So 2012, 13, 14, 15. So we are in year 3 because 2012, 2013 financial year 1, 13, 14 14, 15. So we are in year 3 since amortization began. They started on the financial year 1st June 2012. 1st June 2012 goes to May 2013. So that is 1. June 2013 to 14, 14 to 15. So we are in year 3. We are in year 3. So what you will do, maybe you can have something rough outside here. They are saying they are using the sum of digits. Sum of digits method goes this way. So right there, have a small working sum of digits. When you are told to work with sum of digits, you count the number of the useful life. They have said useful life is 5 years. So the sum of digits will be year 1 plus year 2 plus year 3 plus year 4 plus year 5. So 1 plus 2, 3, 3 plus 3, 6, 6 plus 4, 10, 10 plus 5, 15. So that is the sum of digits. That is the sum of digits. If they say sum of digits is year 10, is 1 plus 2 plus 3 plus 4 plus 5, that is the sum of digits. So we are in year 3. We are in year 3 of amortization here. So our amortization will be 3 over the total sum of digits, which is 15. So you take 3 over 15 times 3 over 15 times the cost of the software, which was 9. How much do you get? 3 over 15 times 9. $1,800, Joy. Thank you. 1,800. Good. And by the way, sum of digits, even coincident. There is a way it is done. Let me show you. Ebu check amortization for 2014. Ile schedule ya huko juu kabisa. Amortization in 2014 they are giving us 2,400. Can you test? 2014 was year 2 because they started in 2012. 2012, 2013, 1, 13, 14, 2. So if you use the 2 over 15 times 9, will you get 2,400? A book confirm for me that. I'm trying to confirm their figure, the one they did for 2014. Because 2014 was year 2. If you take 2 over 15 times the 9, will it give us the 24? When they saying no, what are you getting? Inakuja ngapi? It's coming to 1,200. Yes, because that is not how sum of digits inafanywa. Hii imekuwa coincident. That 3 imekuwa year 3. Sum of digits is done on reducing balance basis. We normally assume, not even assuming it's the truth, asset normally loses value, the highest value in the first years of operation. Hata nyinyi wote, except none. Mtu akinunua simu mpya, new phone, hiyo simu inashikwa inalala mpaka hapo kwa kitanda. In the subsequent periods to come, inaachwa hapo kwa meza, mtanichajia. So even the handling inakuwa chini. So the asset will lose the highest value in the first year of operation. So in year 1, when you are using a sum of digits, year 1 you allocate the highest. So year 1 will go with 5 over 15. Then year 2 goes with 4 over 15. Year 3, ndio nimekwambia hii yetu ni coincident. Ilikuwa year 3, so inaenda na 3 over 15. But if I was to do year 2, can you do actually confirm 4 over 15 by 9, whether you will get their figure kindly? So you go as you reduce. Yes, Mona says yes. So year 4 goes with 2, then year 5. Hata ni ukweli, even matatu, ukinunua matatu for the first time, mnaitanga manyanga. That is when it does not even obey the traffic rules. Iko kwa pavement, party, everywhere. It loses the highest value. So when using sum of digits, This one I could not go without mentioning. Ours was just a coincidence, it was 343. But if it was the first year, you take the highest. The highest. Thank you for understanding. So can you add for me the total? Then we subtract the wear and tear and get the taxable profit. Joy, 64,000. 64,000, that has been confirmed. Then now you less wear and tear. Wear and tear is the capital allowance. Wear and tear is the capital allowance. So let's read note number 3, the last bit of note 3 to get the capital allowance. Plant is depreciated at 20% per annum using the straight line method, while wear and tear allowance on plant is provided at 25% on reducing balance. Reducing balance means on the book value. So wear and tear is for tax purposes. Therefore, we charge it on what we call WDV, written down value, not net book value. For tax, we talk of written down value. So written down value, as we go to deferred tax, is what we call tax base. In this case, tax written down value on 1st June 2014 was 18,500. So for tax purposes, we check the tax base. Tax base is the written down value, which is 18,500. So you will take 25% of the written down value, which is 18,500. So what is 25% of 18,500? Then 5% of 18,500, somebody? $46.25. That one you are allowed to subtract. So what you get here is the taxable profits. That is the taxable profit. So 64 minus 46.25, we are likely to get. You are getting joy 59,375. 59,375. Therefore, current tax will be what percentage? In 2014, check 2014, how they computed their tax. They computed at 25%, if you check there. However, 2015, we are being told in note number 6, check note 6. Check note number 6. Note 6, corporate tax rate applicable on the company's earnings for the year ended this is 30%. So someone may be questioning, why was it 25? The company was newly listed. When a company is newly listed, listing means being quoted in the stock market. There is always that tax. Unit tax, amnesty, ama tax benefit unapewa for some time, lakini sijui kwa nini walipewa only. Maybe that 2014 was the last year. So wanapewanga small tax kidogo. So 2015, 30%. So you take 30% times the 59,375. Get your answer. And that is your current tax. That is your current tax. Full stop. Something small down there before I jump to the next issue. Write for me this. Write for me this. Current tax for the current and prior periods. Current tax for the current and prior. Current tax for the current and prior periods is recognized as a liability. Ama tungeandika hapo subtopic recognition. I want to tell you how to recognize. I think ungeandikia hapo, but you can still write where panga note that. Current tax for the current and prior periods is recognized as a liability. To the extent, as a liability to the extent that it has not yet been settled. As a liability to the extent that it has not yet been settled, and as an asset to the extent that the amount already paid, to the extent that the amount that has already been paid exceeds the amount due. Exceeds the amount due. Full stop. Full stop. So in case examiner alete mguu hapa kwambie how do we recognize? Because you know, we accountants, our work is not computation. That is something which we need to know. Computation is watu wa maths. But now we are always tunafanya two tiers. Tier 1 is to calculate and tier 2 is to recognize. That is the work of accountant. So ours doesn't stop at calculation. So right now you have calculated the current tax. So what? Unaipeleka wapi? You as accountant, you need to know how to recognize. So examiner mostly are very keen on recognition. So the current tax, it depends. Current tax can be current tax liability or it can be current tax asset. So you recognize it in the books as a liability if the amount due has not yet been settled. Kama hujalipa the amount due, recognize a liability. And if the amount that has already been paid exceeds the amount due, umelipa more. Unajua ipa na KRA ya kila siku. So if you have paid more than what you are supposed to pay, then you recognize current tax asset. So if the examiner asks you in exam to explain the recognition of current tax, then you just tell them current tax is recognized as a liability when the amount due has not been settled, and as an asset if the amount paid exceeds the amount due. Full stop. Allow me to bring up Mr. Deferred Tax. So right there. So current tax hakuna kitu kubwa watakuuliza. Watakuuliza tu maneno ya allowable and disallowable. Hawaletangi current tax ikiwa complex. So let's go to deferred tax. And as I told you there before, just in case someone is not there, I said, if kitu tukifanya, let's do it practically. I said, let's be like someone watching a movie, a 3D or a 7D movie, tukue hapo ndani. Let's behave as if we are in the office doing this thing together. Ikue part, si ati ile mambo ya kukram, kushikilia, yenye ukishtuliwa kidogo inapotea. Let's have it in the blood. Now, deferred tax is a very big issue, which most companies hata wanahepa hiyo story. Wataki kabisa, people don't want deferred tax. But allow me to bring the background of deferred tax, how it comes. Deferred tax arises in three ways. Number three will be the one we are going to rely on most. So let me start with these kawaida ones. The kawaida ones, one, right now you have calculated this current tax. So due to some justifiable reasons, you can write to the Commissioner of Domestic Tax Umwambie, we acknowledge a current tax of this for the financial year ending 2015. However, due to this and that, we intend to pay the amount in the year 2016. So if that is accepted, then in the books you recognize that one as deferred tax. So deferred tax, let's view it in futuristic, tuangalie huko mbele. So you have, yes, you have tax to pay and which you have acknowledged, but due to some reasons, hauwezi lipa, biashara imechomeka or something, hauwezi lipa, then you request for a period to pay. So if you intend to pay after the current financial period, then in the books you make what is called provision for deferred tax. That is one simple way in which deferred tax arises. Number two, you have an asset which is generating cash flow. Vile tulikuwa tunasema matatu mpya inaleta pesa mingi. So as an accountant, accountant should be prudent. When the cash flow is high, you can make provision for future taxes, because hata asset ikiwa mzee, hebu angalia gari matatu ikiwa mpya, ikiwa mzee, bado utalipa. Which tax do you pay for this vehicle? Advanced tax. Bado utalipa advanced tax hapo kwa serikali. So what accountant can do, what accountant can do, these people normally assess tax based on the tonnage and even the capacity of those matatus. So whether it is old or new, utalipa your tax. So what my accountant can do, at Afra, right now we are generating more cash flow. Let's set aside some funds to cater for future taxes in case the asset is now old and not generating much cash flow. That amount which you are setting aside to pay for tax when the asset is not generating much cash flow, that is deferred tax. So those are two ways. Now the last one, which is now the most critical, which we are going to apply here. Allow me to take the Kenyan tax system, how it operates. The Kenyan system operates this way. And I'm viewing corporate tax. The accountant, and let me pick the financial year ending 2022. Yes, 2022. So this is 31st December 2022. The accountant, as per how Kenya's how we have been given the guidelines, you are supposed to pay what is called installment tax. Kuanzia March. So 2022, you are supposed to pay installment tax. Mpaka 20th of December should be the last one. Unalipa your installment tax for year 2022. So accountants atakuwa amefunga vitabu. Most companies, though not all that, most companies will close the books on 31st December 2022. When closing the books, most on the assets. Assets, you close the books at net book value. Net book value will be the cost of that asset minus the accumulated depreciation. Accountant amefunga vitabu hapo. Amesahau. Come next year, tukianza January, before 30th of June, you know very well, audit will be done and the returns will be filed. So during this period of January to June, the taxman here represented by the auditor, watakuja kufanya books and disallow some expenses. So one of the expenses which will be disallowed is Mr. Depreciation here. So when taxman comes and disallow depreciation, immediately depreciation is disallowed. So taxman will assess or will recognize the assets not at net book value. They will recognize assets at what we call written down value, WDV. That is what is recognized for tax purposes. In which case, this will be the cost minus the accumulated wear and tear allowances. So taxman will go for the cost minus the wear and tear. Accountant had already closed at cost minus depreciation. So there will be an issue because depreciation is not going to be allowed here by the tax man. So it will bring tax implication because in determination of accounting profit here on 31st December, accountant had already subtracted depreciation as an expense. Huyu anakuja anakataa. The way we have done it there, they add it back. So it means depreciation, that amount of depreciation will bring tax effect. Kama ilikuwa 30, make sure hiyo 30, or be aware that 30 will attract some tax hapo mbele because taxman is going to disallow. So the accountant, based on your previous experience, when you charge depreciation of 100, which is going to be disallowed, then what you can do, unasema ni 100, yes, 100 will attract tax of how much? 30%. So it will attract 30. Then when you are closing the books here, you make provision to avoid overstating profit. So you make provision for deferred tax 30. Because you know, si ati hujui, unajua hapa mbele it is going to be disallowed. It is going to be disallowed hapo mbele. So you make a provision here that when I charge depreciation, it will bring tax implication hapo mbele with auditor. Then you make that provision immediately. So this amount of depreciation, we call it temporary. Temporary difference hapa. Temporary means kwa lugha nyepesi ni kwa muda tu, then it will be rectified. It is temporary because between this period, itakuwa disallowed, it will be reversed. So it is just for a small period there. So you make provision. It's something which even you people can do. You just know, nikiweka hii depreciation of 100, taxman atakuja to disallow. Then they will charge tax of 30%. So you make that provision in the financial statement. As simple as that. There is nothing dangerous there. So when dealing with the deferred tax, we normally tend to check what we call temporary and permanent differences. Permanent are those which they will never be reversed. You check what causes the difference between here and there, then you subject them to tax rates. So hata kama I hope umeelewa. Elizabeth, have you at least understood the background of this deferred tax? Hata kama ni kidogo. Nyabuti, umeelewa hiyo maneno? Yes, Elizabeth says yes. So allow me to give you a small introduction up, then we march forward. So right there and say, deferred tax are future. Deferred tax and future tax liabilities or tax assets. Future tax liabilities or tax assets which arises from either permanent or temporary. Permanent or temporary differences. Permanent or temporary differences. Full stop. So write for me down there. Write for me down there. Permanent differences. Permanent differences. Then you say it is the difference between between, in fact, story. Let me cut it down this way. It is the difference between the allowable and disallowable. Yes. It is the difference between the allowable and disallowable, the allowable and disallowable expenses. Expenses or the difference between the book tax expense, the book tax, there is what we call the book tax expenses, the book tax expenses, and the actual tax owed. The actual tax owed. Full stop. Full stop. Full stop. Another hyphen. Another hyphen. It may also arise due to the difference between the taxable profits. It may also arise due to the difference between the taxable profits and accounting profits. Between the taxable profits and the accounting profits. That originates in one period, and do not reverse in the subsequent periods. Do not reverse in the subsequent periods. Full stop. Full stop. You must have so many definitions of permanent differences. The one you can use is that third one, the difference between the taxable profits and the accounting profits. I'm not wasting time on permanent differences. The standard is temporary. So I'm going to waste my time on temporary. So write for me there, temporary differences. Temporary differences. Temporary differences. That is where the standard requires us to calculate deferred tax from. Temporary differences. Temporary differences. So right there and say, is the difference between the carrying amounts, the difference between the carrying amount, the difference between the carrying amount of an asset, the difference between the carrying amount of an asset or liability, the difference between the carrying amount of an asset or liability, the difference between the carrying amount of an asset or liability in the statement of financial position, in the statement of financial position, in the statement of financial position, and its tax base. And its tax base. Full stop. Full stop. i.e., that is temporary differences down there. Temporary differences is equals to the carrying amount minus tax base. The carrying amount minus the tax base. So two important issues coming up. What is the actually we indicate to shorten our issue as we move ahead. Carrying amount is the one we normally call net book value. Carrying amount is the net book value. Then tax base is the written down value. written down value. So, because the only one I'm going to define, could define salary, this one here. So I want to shorten it this way. Excuse. Carrying amount, the book is yours. Cost minus accumulated depreciation. That is how you get the carrying amount. You take the cost of the asset, you subtract the accumulated depreciation, and that is how you get the carrying amount. Tax base, you take the cost minus the accumulated, where I get wear and tear, whatever capital allowance, minus wear and tear. So the deferred tax will be calculated from temporary. And how do you get temporary? You will take the carrying amount of the asset minus the tax base. Carrying amount, which is in the net book value, you just take the cost of the asset, you subtract the accumulated depreciation. Tax base is for tax purposes, so they don't check depreciation, they check the wear and tear, so it is cost minus wear and tear. Cost is constant. Yeah. So what brings the difference is the depreciation and the wear and tear. That is where the variation comes, and that is the temporary difference. Down there, right for me, tax base of an asset or liability, tax base of an asset or liability, is the amount attributed, to that asset or liability, for tax purposes. Tax base of an asset or liability is the amount attributed to that asset or liability for tax purposes. Full stop. So the amount attributable to an asset for taxation, that is what we call tax base. That is what we call tax base. Msikia sasa kuna watu wakiare wanatembea huko around also in the cities. Wanajiita, we have two of them. Sijui kama nani wametembelewa, by the way, it's good to know sometimes. Tusikwe tunaandika tu without knowing what is happening. Nani there is this KRA team which are walking around. Who has come across, maybe where you work, umetembelewa kidogo? If none, then soon you will be visited. They are of two groups. There is one called TBE, and there is compliance and enforcement. TBE, in full, they are calling themselves the tax-based expansion officers. They are the ones having paramilitary training. So tax-based expansion officers, they try to ensure that the tax base of an entity imekuwa kubwa. So how do they ensure? For example, kama una ETR, weka huyo mtu kwa e-teams, weka huyo hapa. So at least they expand the amount which can be attributed for tax purposes. So when we talk of tax base is the amount which is subject to taxation. That is what we call the tax base. All right, we proceed. So now, hold on. We have two types of temporary differences. If the book value is 50 and the tax base, what is attributed for tax is 30, then the temporary is 20, which is positive. If it is the other way around, 30-50, then we have a negative temporary difference. So temporary differences are classified into two, depending on whether the carrying amount is more than the tax base or carrying amount is less than the tax base. If you get in circumstances where the book value is more than the tax base, that is positive, then this one is called taxable. Taxable TD, temporary differences. If you have a negative temporary, the book value is less than the tax base, then we talk of deductible temporary differences. In which case, taxable becomes a liability. It gives rise to deferred tax liability. After VAT, if you have a positive, you need to pay. So positive, temporary, will give us what we call deferred tax liability. Negative, when you multiply by tax rate, it will give us what we call deferred tax assets. So deferred tax asset arises when we have negative temporary differences. And when we have negative, when the book value is less than what is due for taxation. So write for me a subtopic, types of temporary differences. Types of temporary differences. Types of temporary differences. Here you see media as such. So types of temporary differences, because there are two, let's not waste time highlighting them again. So let's just write, we explain together. So let's start with the first one, taxable. Taxable, temporary. Temporary differences. Taxable temporary differences. That is the first one. That is the first one. Then you say, are the temporary differences that will result in taxable amounts. Are temporary differences that will result in taxable amounts. In taxable amounts. In determining taxable profits. In determining taxable profits. Taxable profits for future periods. For future periods. Deferred tax is futuristic. For future periods, full stop. Full stop, continuation. It arises when the carrying amount of an asset or liability, exceeds the tax base. Exceeds the tax base. Exceeds the tax base. Full stop. Full stop. Continuation. They give rise to deferred tax liabilities. They give rise to deferred tax liabilities. Give rise to deferred tax liabilities. Full stop. Full stop. Full stop. Let's go to the last one. Deductible. From the word deduct. Deductible. Deductible temporary differences. Deductible temporary differences. Arises when the carrying amount of an asset stock liability, is less than its tax base. Is less than its tax base. Full stop. full stop, arises, no, they give rise, sorry. They give rise to deferred tax assets. They give rise to deferred tax assets. They give rise to deferred tax assets. Full stop. Full stop. Hivyo. So now, I want you to do for me something. Hapa kwenye muliandika taxable. This number one, taxable temporary differences, because I don't want to go back for more stories. Have it in brackets. Taxable is also known as positive. So we can bracket positive TB. TB stands for temporary differences. So that is called positive. There's another name, positive temporary differences. The number one deductible, number two, you put in brackets negative TD, temporary differences. So negative gives rise to deferred tax assets. Positive gives rise to deferred tax liabilities. So there was unit sitting gun. Students were also told to differentiate between a deferred tax liability and a deferred tax asset. So I don't know whether to define that or you can pick it from here. Whichever way, deferred tax liability are those deferred taxes which arises from taxable temporary differences. Ukishasema hivyo umalizana na examiner. Deferred tax liability arises from the taxable temporary differences, while deferred tax assets arises from the deductible temporary differences. Down there you say, note, make a note, deferred tax assets, deferred tax assets, deferred tax assets arises from full colon, Roman 1, deductible temporary differences, then two, the carry forward, yes, the carry forward of unused tax losses. Carry forward of unused tax losses. Carry forward of unused tax losses. And finally, Roman 3, carry forward of unused tax credits. Unused tax credits, full stop. So the deferred tax asset will arise in that way. One, deductible. Deductible means carrying amount is less than the tax base, so negative, from negative temporary. Then two, the unused tax losses. When you have a tax loss, you're supposed to reduce your liability. So it's an asset because of the future. Also unused tax credits. Tax credits is when you had negative from previous financial periods. Tunakanyaga mbele, down there, you say, down there. Therefore, deferred tax is equals to temporary differences. Times the tax rates. Unless otherwise, tax rate we are going to maintain at 30%. So block out that. This is going to be very important for us. Have that one there. That is how you calculate the deferred tax. So any moment, examiner amekuambia they want deferred tax, you first of all think from that formula. So sioni kitu kubwa. I think the only thing remaining is to take you to computation. Let me say that. But kuna kitu hapo. Deferred tax recognition is just the same as others. Niandikia hapo chini subtopic kidogo, measurement of deferred tax. Yes. Measurement of deferred tax. Measurement of deferred tax. You say deferred tax asset stock liability. Deferred tax asset stock liability. Deferred tax stock liability are measured at the tax rates. Are measured at the tax rates. Measured at the tax rates that are expected. That are expected. That are expected to apply. Expected to apply to the period. Expected to apply to the period when the asset is realized. When the asset is realized or the liability is settled. Is settled. Full stop. Full stop. That is enough. Write for me the illustration. I think I can. Whether pambana na illustration moja sahi. Write the illustration. Get out the papers. I can check. Kuna effect of revaluation on deferred tax. Hiyo tutapambana nayo tukifanya swali. So write the illustration. Can give you hata kufikia swali hapo. Ile ingine tulianza nayo 2015 hiyo tutakuja baadaye. I know it's time. I know when to bring it up. Get your papers ready there. Get your past papers ready. Allow me to start with May 2017. Allow me to start with May 2017, question 4B. Mtu amepata wa kwanza, please, can you give us the page? Because we have to the current paper. Mine is not compatible with yours. May 2017, question 4B, there is a question there, which we can tackle perfectly. December, May 4B, and I'm there. Who has gotten it and which page? Yes, it's this one. Page 108. Page 108. Kindly check that. My students are ready. And I read. Ini Munro ama Mandro, whichever wewe unajua kusoma, ila is not my issue. Tulifunza na walimu tofauti. Limited, a manufacturing company, provides for deferred income tax in accordance with IS number 12 of income taxes. The following is an extract from the statement of financial position as at 30th April 2017. Your balance sheet, let's go to the additional information. Let us go to the additional information. Number one, the tax base of the assets are as follows. So, property, plant, and equipment there, prepayments given, interest-bearing loans given, financial assets available for sale given. Inventories are stated at fair value. Remember, fair value is the market value, less cost to sell, which is lower than the original cost, due to general provision for price decline of 3.5 million. No problem. The intangible assets comprise development cost, which is tax deductible. Deductible means allowed. Deductible when the amount is paid out. The cost of intangible assets was paid in the year 2014. Remember, we're in 2017, and is presented net of amortization cost. Goodwill and employee benefits are tax exempt. Tax exempt means the tax base is zero because there is nothing to be assessed for. There's nothing to be assessed for tax purposes. So tax exempt means tax base is zero, and even temporary is zero. There is nothing to assess, regardless of the book value. Regardless of the book value they have, the tax base will be zero. The temporary differences will also be zero. Correct. Trade and other payables include provision for leave allowance of 1.4 million, which is tax deductible on cash basis. Cash basis means when paid. So you only tax them when paid. The receivables are stated net of the general allowance for bad debts at the rate of 5% of the gross receivables. The general allowance is not tax deductible until it becomes specific. So the building, which is included in PPE, was revalued during the year. The increase in value of 3 million does not affect tax base. Fine. The tax base of other items is equal to their carrying amounts. The tax rate is 30%. Required one, deferred tax balance as of 30th April 2017. Two, deferred income tax account. Fine. 12, 2 marks, 14. Now, let's go straight. So recall how to calculate deferred tax. Deferred tax is computed from temporary differences. And how do you get the temporary? Temporary is another difference between accountant and taxman. Accountant ndio huwa anaanza kufunga vitabu pale December. So accountant will close the books at net book value. That is what you need to know. NBV. So you will first analyze all the carrying amounts. Then we bring up the taxman. Taxman anakuja next year June. So yeye akikuja anakuja na tax base. So you come and check the tax base. Then now the difference between the accountant hapo kwa carrying amount and the tax base is temporary. So once we have all the temporaries, it means we can get deferred tax. Deferred tax is tax rate times temporary, because you see that gap between accountant and taxman will bring tax effects. Here, those variation in amount is tax effect. And how do you get the tax? 30% times that's the difference. So bring the accountant, bring the taxman, get the total, multiply by 30. That is deferred tax. Something else of concern, unless otherwise stated in this one, assets are recorded as carrying amount in the balance sheet. So the figures appearing in this balance sheet, unless something is contradicting, these are the carrying amounts for your information. Unless the examiner said that one was recorded at cost, fine. But to the extent they have not mentioned, then these are assumed to be the carrying amounts. So those the values you are seeing in the balance sheet are the carrying amounts. So we kick off. This is the arrangement. Right here, Mandro Limited. Mandro Limited. Deferred tax. Deferred tax. Computation. The one for which year? How's that? 30th April 2017. 2017. So have that. So you bring here like that. So you are going to deal with the balance sheet, which is assets and liabilities. Then you will give us their carrying amounts. Their carrying amounts. Of course, the carrying amounts are in thousands. You will give us, so please remember, carrying amount and the net book values. Then you will give us their tax base. Tax base. So tax base is the written down value, also in thousands. Then the difference, the gap between the two is the temporary differences, also in thousands, like that. So once I collect all the temporary, I sum them up, na chapa na tax rate nimepata deferred. So be ready. Be ready, be ready, be ready. People are ready. We kick off. So go to the balance sheet. Bring those assets. Where am I? So the assets, we have property, plant, and equipment. So PP. Property, plant, and equipment, PP. So the book value is 14. That is the carrying amount. Is 14. I said unless the amounts appearing in the balance sheet, those are the book values of the assets. Then now we check the tax base. Tax base in LIV, you check what was the initial cost. If there was no wear and tear allowed by the taxman, then cost always becomes the tax base. But in this question, we were given check note 1. PP, the tax base was given as 28. So that one you just capture. And to dispel some doubt from your mind, I know someone might be asking, I don't know, number 7. So I must remove that from your mind very fast. For number 7, the building which is included in the PP was revalued during the year. The increase in value was 3 million. So now, when they say during means, actually 30th April. It means from the beginning, May 2016. The year starts from January to December. So when you say during, in that period of January up to December. But you see the balance sheet, which is reporting the 14, is as at the end of the year. So when we have been given the value at the end of the year and revaluation took place during, it means the revaluation has already been included in the closing balance. So to dispel that doubt, the 14 includes the revalued amount. Kindly note that. It includes the revalued amount because revaluation was during. 14 is at the end. So the end balance already includes the revalued amount. So how much is the temporary? Now temporary is between the accountant. Remember carrying amount the accountant. Tax base is the taxman. So 14 minus 28, we get how much do you get, ladies and gentlemen? Chop 11,200, 11,200. It is not important to tell the examiner but just for the sake of it, 11,200 is called TT, taxable TTD. Is not good, it's not a must you indicate, but just for knowing purposes, this is taxable temporary differences. Positive temporary is taxable. Taxable means it will give rise to a liability. Correct. Let's go to the next. The next one is intangible assets. Intangible assets. So intangible assets in the books, they have been recorded at 4 million. Recorded at 4 million. In which note? There was a note talking about intangible. That was note number 3. Check note 3. Check note 3. They are saying the intangible assets comprise development cost, which is tax deductible when the amount is paid out. The cost of intangible assets was paid in 2014 and is presented net of amortization costs. Scale your story out. They are saying it is tax deductible. Tax deductible means allowed, to deduct. So it is allowed for tax when the amount is paid. That is the first thing examiner is communicating. It is tax deductible when the amount is paid. Then subsequently they are saying the amount was paid in 2014. So it means the entire cost was allowed in 2014. We are in 2017. So it means the tax base is 0. There is nothing to assess for tax because they are saying it is allowed for tax purposes when the amount has been paid. And the amount was paid in 2014. So it means the entire cost was allowed for tax purposes. Allowing means there should be no tax base there. But this book value will be assessed. We are coming up with patents, copyrights. Mostly patents, unapewa time because you need time for innovation and the rest. You are allowed in full for tax purposes. But as we go into the future, umeanza kuimba uko na copyright kama hao wengine, they will start taxing that royalty. So the book value will attract temporary. So even that one is taxable. It's not a must indicate those things in the exam, the TTD and the whatever. So perfect. We go to the next. Goodwill. Goodwill is funny. Goodwill is quite funny. Always. Goodwill, the book value is 6. Lakini hata wasiposema inakuanga tuna tax base of 0. But they have said, check note number 4. Goodwill and employee benefits are tax exempt. Tax exempt, but hata wasiposema, kwani wewe unaweza inaandika goodwill in the books then ikuwe na taxable. Here this for taxman. Taxman will not assess tax on goodwill. Ukijaribu, nobody will ever report goodwill. Utasikia TV ni hustler tu. Tunajaribu tu kwa hii dunia, biashara yetu inayumba yumba. Au utasikia Safaricom wako na goodwill. We are just trying to try. So goodwill always, hata kama wangesema goodwill has a tax base of 0, and by extension the temporary is also 0. What is brought here will always attract tax. So goodwill, regardless, that is a rule. Regardless of any item which is tax exempt will have a 0 temporary difference, regardless of the book value. But you see, intangible assets, this is not something zero rated. Zero rated are taxed. So so intangible, yes, they were allowed. But in future, should they have book value, that one should be assessed for taxation purposes. So any exempt has tax base of 0 and temporary of 0, regardless of the book value. Please master that. We proceed. FA is the financial assets. Financial assets, I'm seeing a book value of 12. Book value of 12. But tax base was mentioned in note 1. Check note 1. I'm seeing there 14. This is 2, but negative. This is BTP, deductible. That attract tax asset is a negative tax base. Negative temporary. Umeanza kushika, tusonge. Let's go to current assets. Inventories. So we go to inventories. Inventories, the book value is 75. The book value is 75. Inventory was mentioned in note number 2. Inventory was mentioned in note 2. Inventories are stated at fair value less cost to sell, which is lower than the original cost. Lower than the original cost. So this 75 is lower than the original cost due to a general provision for price decline of 3.5. So it means the initial cost is 7.5 plus 3.5, which is 11. So taxman akikuja, people can pretend that there was price change, nini. Taxman akikuja hapa kwa tax base, anakuuliza what was the original cost? The original cost was 11. Now why are you recording 7.5? Because there was a price decline. That is none of their business. People will talk of price decline to understand tax. So taxman akikuja anakuuliza what was the cost? Cost was 11. The next question is, did we allow you anywhere and tear? No. Then they assess tax on that cost. So taxman will assess on cost. Price decline. Therefore, we are reporting again negative temporary. We proceed. Trade receivables. Receivables. And this is how we determine the tax. Receivables, the book value is 6650.
Excuse me, Mwalimu.
Yes, please.
Kindly just repeat the explanation for the inventories.
The inventories, they are saying it was stated in the books at 75, which was lower than the initial cost due to price decline of 3.5. So you ask yourself, what was that cost? You gross up to get the initial cost before the price decline, because they are saying this amount is net of the price decline. So it means the initial cost was 11. So for taxation purposes, taxman anakuwa very simple. What was the cost of the stock? It was 11. Did we allow you wear and tear? Because tax base, they will only take the cost minus wear and tear. In the event that wear and tear is not there, then the cost becomes the tax base. So taxman amekuja pale kwa ofisi. Though sikuona nani ameuliza, amekuja kwa ofisi akuta, how are you? Fine. We want to check tax on stock. What was the initial cost of your stock? It was 11. And why are you recording 75 in the books? We recorded 75 because kulikuwa na price decline. No. So with us, we are going to check on cost, but we will allow you. If there was a capital allowance, wear and tear, we will allow that. So here there was no wear and tear, which of course stock is equal to government. So they will have check tax on the initial costs. So I hope Siku Angalia was asking, but I hope you have understood.
Yes, understood now.
Thank you. Receivables. To go for receivables, the book value in the balance sheet is 6650. Receivables was mentioned in note number, which one? 6. Check note 6. Check note 6. Trade receivables are stated net of general allowance, net. So it means this value is net of general allowance at the rate of 5% of the gross. So this value is net. So tell me, they are saying net of the doubtful debts of 5% of gross. So this 6650 is at what percentage? It is equated to what percentage? Because maybe nataka kurudi huko juu kwa gross kwanza. I want to go back to the gross. So 6650 should be what percentage? Vera, 95, I agree. So 6650 is at 95%. I want the initial figure, because these people always appear doubtful debts, what are the state tax? Actually, taxman has never allowed doubtful debt unless they are specific. So what about 100%? Me, I want 100%. So gross it back. This times that divided by 95. That is what I want. I want to go back to the initial cost, 7. So this 7, you're gonna negotiate. Is there any allowance? No. Taxman will assess it on the 7. So they will assess tax on the 7, giving you 350. Please allow me to eat your, come on, 6 minutes if extra. Yeah, like 6 minutes. So when dealing with the tax base, you go back to the initial cost. Muna negotiate where and say, kama hakuna, cost becomes the becomes the tax base. We proceed. We are proceeding to the next one. After receivables, there is prepayments. Prepayments. Prepayments, the book value has been provided as 3,200. We were given tax base for prepayments. Check additional information number 1. Check additional information number 1. Prepayments 15. So 32 minus 15 should be 17 taxable. That is 17. Very good. We proceed. Cash and cash equivalent. Cash and cash equivalents. Book value 1250. Cash and cash equivalents was not mentioned anywhere in the notes. So for the ones which have not been mentioned, you refer to note 8. Kama haijaongelelewa kwa any notes, you go to note 8. Note 8 says the tax base of other items is equal to their carrying amount. So the ones which have not been mentioned anywhere, they have said their tax base is the same as the book value. So there is no temporary. Good. Next one, equity and liabilities. Listen to me. We don't assess tax on equity. Ukijaribu kutax equity, ile kizungu inakuja. Nilianza hii biashara na ndoto. Niliona tu na nikaanza, sikuwa na pesa ama nilichora tu. So you don't, there is no tax on capital. If you try to tax people's capital, you will realize nobody will ever declare their capital. Anasema mimi nilikuwa na nyota ama nilikuwa na ndoto. Nothing. So there is no tax on equity. So escape the entire equity. Escape the entire equity. Nyinge, Joshua, wewe ulianza biashara aje? How much capital did you start with? So let's go to non-current interest bearing loans. So interest bearing loans. That's a liability. So interest bearing loans, the book value has been given as 16,000. This is a liability. You cannot add liability with the assets. So have the liability in brackets. Thank you for understanding that. That is mentioned in note 1. Check note 1. Interest bearing loans, 17. So it is minus 16 minus 17. So here you report positive 1. You report positive 1. It is a liability. So minus. Next, I think we are somewhere. Deferred income tax. Don't assess tax on tax. So there is no, don't bring tax here. Ignore. Trade and other payables. We are finishing. Where are the payables? Hiyo kizungu ni mingi. Payables. This is 8. There, it was mentioned somewhere. It was mentioned somewhere in note number, which one, student? Note number 5. Check note 5. Check note 5. Trade and other payables include provision for leave allowance of 1 point. So this amount include provision for leave allowance of 1.4, which is tax deductible on cash basis. So the 1.4 will be taxed. Cash basis means when paid. But as we talk right now, the examiner has not said whether that amount has been paid. So there is nothing. So you subtract 8 minus 1.4. So that 8 minus 1.4 is 66. That should be 66. So that is, I hope so. Minus 8 minus, yes. Itakuwa positive ama negative? Minus 8. Itakuwa negative. That is negative. Minus 8 minus. Yes, itakuwa negative 14, correct. So they have said, I repeat, they have said included in 8, there is amount of 1.4, which is tax allowable on cash basis. Cash basis means you amount ikilipwa, you are allowed to subtract. For now, no. So it means what we assess is the 66. It has not been paid. Next, at last, employee benefits. Employee benefits. So employee benefits, the book value is 2,000. 2,000. Your attention is being drawn to note number 4. Your attention is being drawn to note 4. Goodwill and employee benefits are tax exempt. When exempt, the tax base is 0 and even temporary is 0. Tax exempt means if I could want anything to do with tax at all. The last one was current tax, but current tax, we don't check tax on tax. Therefore, you have to realize we are done. And for me, the total temporary differences of the assets and liabilities. Kindly add. Kindly add. The first is getting 10,650. 10,650. 10,650. Confirmed. Thank you. So down there, I've run out of space, so I'm going up, but we'll proceed accordingly. Therefore, deferred tax liability. Therefore, liability, because it is positive. Ingekuwa negative, you talk of deferred tax assets. So therefore, deferred tax liability is equals to tax rate times your 10,650, giving you how much, ladies and gentlemen, there? What do you get? What do you get? You get 3195. That is your deferred tax, and you get 12 marks. So 12 marks, what they will mark is this temporary, this column of temporary. They will mark these temporaries, and of course, the deferred tax itself. Please, I don't want to leave this question hanging. So again, give me, kama ni mingi ni 4 minutes, tumalize vizuri. Part 2 is deferred tax account, 2 marks. So of course, it is serious. So let's just finish well. Deferred tax accounts. I want to do 2 things. Deferred tax accounts that it will get up on our measure. Then we are done. So when you are told to bring deferred tax account from and to, you say here, deferred tax account. So deferred tax account, like that. So, but you just draw it that way. pass. So now you start with the opening balance. Listen to me and listen carefully. Deferred tax can be asset, it can be a liability. So you start by checking the opening. If it is a deferred tax asset, the opening figure, if it was a deferred tax asset, the balance broke down will be on the debit side. If the opening was a liability, you bring it on the credit. So yes, check our balance sheet. Our balance sheet, deferred tax was appearing under non-current liabilities. So we had a liability of 1,200. So balance brought down 1,200. Yeah. 1,200. Then the closing is also liability. Liability is carried down on the credit. You utafungua next year on the credit side. So balance carried down. Whatever we have computed, we got 31.95. Correct. Now, hapo ndio kuna kitu kidogo wanapendanga sana. Check here. Deferred tax, when we started the year, there was a provision. This is a provision. Deferred tax is always a provision for future. So there was a provision of 12. When closing, the provision is 31.95. Increase or decrease in provision is tied to the profit account. So what is the increase, please? 12 to 31.95 is how much? But don't post it anywhere. 12 to 31.95, that increase is how much? Somebody? Chap, tumalize. That increase is 19.95. 19.95. So now the increase of 19.95, you should take it to the profit account. Increase in provision is an expense. So what should go to the P&L is this increase of 19.95, which you bring here, P&L balancing figure 19.95. But I'm not going to do that. The reason being, there is an asset which was revalued. There's an asset which was revalued during the year. So during the year, there was revaluation in note number 7. There is an asset which was revalued by 3 million. That 3 million was already included in PPE. You remember when you were doing PPE, check your PPE in the computation. The book value is 14 at the end of the year. So that 14 already includes the 3 million. And it has no effect on the tax base. On a PPE, carrying amount 14. Then the examiner will say that it does not affect, check note 7, it does not affect the tax base. So the tax base, which was 28, was not affected by revaluation. But remember the 3 is here at the end of the year. So that 3 went to the temporary. So temporary also increased with the proportionate increase in the assets. So temporary also went up by 3 million. So this 3 million in the temporary was taxed. So when arriving at this 31.95, there was this 3. The 3 is there. So the problem I have, if I just say the balancing figure straight, 19.95 here, the P&L, I'll be very wrong. Because it means I'll be taking to P&L tax as a result of revaluation. Revaluation is an equity component, is OCI. OCI is other comprehensive income. I've said that so many times. Revaluation is other comprehensive. It does not go to P&L. So it is our duty to eliminate, to know what goes to P&L, you need to subtract the deferred tax inside this 31, which was brought by this revaluation. Of course, it brought 3 by 30, which is 900. So inside the 31.95, there is 900 due to revaluation. So 900 should not go to P&L. So to get what goes to P&L, subtract the 900 from 31.95. How do we subtract in accounting? You credit the account. When you credit, it means you have reduced this. So you come here and say, revaluation, 30% of that 3. 30% of 3. 30% of 3 is 900. So 900 was brought by revaluation. Imelala hapa ndani. We don't want to take it to. If you don't eliminate by crediting, utaipeleka kwa P&L. And revaluation is equity. Equity does not go to P&L. It is other comprehensive which goes to the balance sheet. Therefore, what goes to P&L, the balancing figure. How much students now, after you have eliminated that, how much do you take? We are taking how much? Hebu toa hiyo 9. Itabaki 1095. Okay, no, 1995 minus 9. Hebu confirm 10, yes, 1095. So 1095 is what goes to P&L. Correct. So tumemaliza as per the examiner. But there's a common question wanapenda sana kwa deferred tax, especially wakiuliza hii deferred tax account. There's a question they really like. Na nisipoweka hapo ni, though in the subsequent questions tutaipata. But I want you muanze kuzoea mapema. Mapema ndio best. Kuna swali wanapenda journal entries to record the changes in deferred tax. Changes how it changed from 12 to 3150. So in your question paper, ongeza hapo Roman 3. But kwa mtihani usiongeze kama hujaulizwa. Even it's a common question for deferred tax, I want you to get used to. So in case you are asked of journal, there are only 2. So nikitulia kidogo. So journal entries. Ukiulizwa anything in this world, ukiulizwa journal entries in accounting, you are simply being asked which accounts to debit and which accounts to credit. Those are the 2 accounts unaulizwa. Journal means which one to debit and which one to credit. Journalizing. So ukiulizwa journal entries in the questions to come, you don't generalize the opening and closing. So we don't generalize this, we don't generalize this one here. The ones which should go to the journals are those 2. So how do I pass the journals? I've credited the deferred tax account. I've created the deferred tax account with the revaluation. So it means the corresponding account to be debited is the revaluation account. Because I've credited the deferred tax with the revaluation. So debit revaluation, so this is journal 1. So debit revaluation, reserve, account with the 900, because I've credited deferred tax. Deferred tax account also with the 900. Correct. Then we only pass this one. Thank you so much. So we are very nice. So the Peana narration, you say to record deferred tax on revaluation. To record deferred tax on revaluation. To record deferred tax on revaluation. Then the last one is this one. Have credited deferred tax with P&L. So the corresponding is the profit account. So profits, so closed, you debit with the 1095. You debit with the 1095. Then I've credited deferred tax. Deferred tax account also with the 1095. With the 1095. You say to record deferred tax expense for the year. To record deferred tax expense for the year. Full stop. We are done. So this question should also help you. Then come it is necessary for me to do this question. It should serve. Let me check December 2022. December 2022. But now that's not the one we do. Unless you tell me that December 2022 question 2, you check that question. I think they are more or less the same. Those two questions are more or less the same. So I'll come with November 2019, question 5B. In our next class, November 2019, question 5B. November 2019, question 5B. Only the same. There's no need of wasting time. When is our next class? Chap. Class, whatever. When is our next class? I hope it was not said. When is our next class? Tomorrow. Yes, I agree, tomorrow. From what time? Time is the issue here. From what time? Ndio tumalize deferred tax, tukanyage kitu ingine. I propose, no, why does that propose to us? Let's start the class at 5:30. 9 a.m. 5:30, 6:30, 7:30. Right? 5:30 to 6:30, 1. 6:30 to 7:30 to 8:30. 9 a.m. is okay. So let's meet tomorrow at that time. I just want to see the people who will wake up. I just want to see. Ikibidi tutaamsha kila mtu na simu. I want to see people will wake up. So kama unaenda kuna ile group wanapumzikanga, sio kama leo Arsenal wanacheza. Kama unaenda kupumzika na wazee, uende mapema. Make sure umelala by 10. Tupatane hapa for further fellowship at 5:30 tomorrow. Tutamaliza the fact that tuanze another topic. Thank you. Do have a nice day. We meet tomorrow. Yes, you remember we have, so you can log out.